Hello and welcome to Pensions in 10 with me, David Brooks, and my colleague, Sadhbh Lynch. This week we take a look at the Pensions Bill, some of the detail, and also the Chancellor's latest spending review.
Okay, Dave, so do you want to bring us through the updates that have come out from the Pensions Bill?
Yes, so as predicted, the Pensions Bill was published when I wasn't around, when I was getting married, which was very exciting, but I still found time to read the Pensions Bill in between vows. No, I didn't. But you know what I mean. So I'm not going to go too much into the detail of the Pensions Bill itself because it's been a little while, and I think most listeners, will have a good handle on what was included. I did want to just take a very quick canter through it, and only in the sense just to give you a sense of the time scales that we're talking about with some of this stuff, because there are some big projects that the government want to do, and so obviously there's a lot of time to get through this. So, for instance, the VFM bit, so they're doing the DC bits first, the VFM, looking at how pension schemes compare themselves, DC schemes compare themselves, that's not going to be coming through until 2028, when schemes will need to do their first annual assessment of their VFM. Mega funds aren't really going to come through until 2030, so that's still the target, where the default fund, which is ill-defined, but the default fund with any provider has to be at least £25 billion. And there's going to be a contractual override as well to allow some consolidation of default funds. So if you've got a default number of default funds set up, and where people have in the same provider, they can't easily be consolidated, but there's going to be a contractual override to allow that. That will come through in 2028, and so we'll start seeing consolidation really pick up speed around about then. The small pots, there's quite a long lead time for this, so we've got through 26, 27, we'll have more regulations. 2029 is when we'll get the consolidators authorised. So these are the entities that will be a sort of a receptacle for some of these pots that will be flying around. And then 2030 until the actual pots start being consolidated. So that's quite a long way off. I'll come back to that, if I remember, at the end of this little section. We also have the default retirement option, so DC schemes to give a default option for members going through retirement. So there's going to be consultations through 26, 27 on that. A lot of thought needs to go into how that's going to actually work, how the guidance is going to work, because ideally you want engaged members, at least to understand what's happening to them, so they can make some, if you need bank details, I think people need to engage at some level, so we need to sort that out. And then the duty will be live in 2027 as well. Similar with the DB surplus rules, the ability to do this stuff will come through in 2027. So there's a kind of a bit of a lag, couple of years until schemes will be able to refund their surplus as an ongoing scheme without having to wind up. And that's the main sort of things, and also the mandation. That's some of that's on the statute. I know you've been looking at this, so I'll come to you in a second just to give your thoughts on it. Being an investment person, you're obviously front and center when you're trying to give advice to members, advice to your clients. Sorry, if you've got this power sitting in the background. But yeah, so that's going to be kicked around. So the regulations, when this becomes Royal Assent in 2026, the mandation power won't come into force then. There's going to be more regulations to help clarify how that's going to work. So Clive, I've got more to say, but I'm going to come to you now and give us your thoughts on a bit more about what's in the bill on mandation, because it is quite an important power in there.
Yeah, so the bill is basically allowing for a wide range of asset classes to be mandated, so in DC pension schemes. So early references within the bill have included private equity, private debt, and then also a range of UK-linked assets. But they did mention that through further regulation, this list could expand. So this isn't a definitive list of the different mandations that they could put in place. So we don't know yet, but through further regulation, we'll know how much must be invested, and then also how the compliance around it is going to work, so that you can demonstrate that you've invested the correct amount in these mandated asset classes. So again, they're not going to do this imminently, but even the fact that these are put in place and these regulations are already here does kind of cause a bit of concern, especially for trustees, because if you have a fiduciary duty to your members, it's kind of conflicting to then be mandated to invest certain amounts in specific asset classes, even if that might not be what's best for the members. So definitely a significant shift in how DC schemes operate, but I guess in the end, they're aiming to boost productive finance. So hopefully it will be positive for DC schemes overall. But again, the bill is still progressing and the implementation of this could take many years. So it's just something to keep an eye on, really.
Yeah, I think there is still, like you hinted at, there's a lot of nervousness about having a government power um, to direct investment in some way, or sort of direct, or maybe more. It's going to be more. We want you to invest in something rather than investing not in something. And could it be green things in the future or other assets? I don't know. Your mind. I don't want to start against some speculation, but your mind can sort of race into all sorts of areas where governments might act in particular ways that may not be within their remit really. I think it's interesting, to know there's probably going to be the regulators that are going to have to police this. We haven't really got much clarity on the compliance and the reporting. There's also meant to be a report from the government issued to the Treasury to sort of justify why this power is going to be used. So again, there's going to be a lot. I think at least as it's written at the moment, there will be a lot of lead time before this power is used in anger. There's going to need to be a lot about reporting, what assets, how they're going to be measured, how the regulators are going to scrutinise that. Fluctuations on day to day, that's ridiculous. It can't work like that. So there needs to be time to rebalance and take action, all these sorts of things. So it's a new area, I think, for the UK to sort of get their heads around. Free market economies don't normally operate in this way, and it does feel a bit slightly new ground. I think it's also worth just moving off of mandation, just to look at the DB surplus side of things. In the impact assessment, there was a lot in there about the costs on industry, and in the DB surplus area, they were talking about over the next 10 years, around 8.5 billion being paid back to employers, and an interesting half and half between employers and then upside sharing with members. And that was something that came out of the DB surplus document that came out slightly before the pensions bill. There wasn't much in there about how upsides can be shared with members, and I think the government does need to think about how upside can be shared with members in a simple way. You don't necessarily want to just be giving more pension increases, say, because that's only going to really work for pensioners. And also could actually compound if you add that to the liabilities, and over time you're actually compounding that increase. So giving one-off increases or one-off lump sums, Christmas bonuses, all these kind of things is something the government probably should think about. And also there was a roadmap document that went out just before the pensions bill as well, which talked about the future. So there's other things. So we've had all this stuff, and this really big picture change the whole framework of pensions in the UK stuff. But also, we've still got the adequacy review, which is going to be launched towards the end of the year. So we need to have terms of reference and someone to lead that. They mentioned more work in the DB space. So the consolidation idea is still around. And within the DB surplus documentation, they were talking about perhaps focusing on underfunded schemes with weak sponsors that were effectively never going to make it to do a risk transfer, whether they should be transferred into a consolidation vehicle, perhaps with the employer still paying in for a while. But then taken over by, run by the PPF, not necessarily into the PPF, but run by the PPF. And then finally, a sort of a review of trusteeship and governance within the trust-based sector, which was, I haven't really read very much about it, but I've noted it in Nautica Delphas's recent speech, and it was in that roadmap document as well. So it feels quite a big area, potentially, if we're looking at trusteeship and governance, and whether we're going to have a review of the regulatory oversight of DB pensions as well. So that could be interesting. So loads to keep an eye on. Okay, so while I was away, there was a spending review. And does this have implications for pension schemes and their assets?
Yeah, so the Chancellor, while you were away, announced a significant increase in the BBB, or British Business Bank, financial capacity. So this has increased to 25.6 billion. And the BBB, for anyone who doesn't know, is a UK government-owned economic development bank, is what they call it. So it basically plays a role in mobilising pension scheme investments into UK-based growth opportunities. So it's trying to kickstart those UK-based growth opportunities, which then pension schemes can follow. So this enables the BBB to invest around 2.5 billion annually, so 70% increase in what they were doing before. And the goal is to crowd in tens of billions of private capital to create a strong pipeline of investable UK opportunities. So they'll kind of kickstart the investment, and then hopefully that will allow different pension schemes to then get involved in those investments too thereafter that. So while it's not explicitly linked, the BBB expansion aligns with the government's broader productive finance agenda. So I know we've been speaking about that a lot in a lot of these pensions and tens. And it also supports the Mansion House Accord. So pension funds have all committed, or some of them have committed, to investing more in UK growth assets. So it kind of links into some of the themes that we've been speaking about in some of the past week's podcasts. So the PLSA welcomed this move, is what they said. So they've highlighted the potential for pension funds to access new projects. So that's kind of the aim of this, new projects in infrastructure, housing, energy, and health investments. So kind of slightly different to some of the assets they might be invested in at the moment. But it's important to consider and evaluate these opportunities, as although they're there and the government's trying to make sure that pension schemes can invest in them, you need to still, as a trustee, consider your fiduciary duty. Is this something that you want to invest in and it aligns with what your scheme needs? And then also the long-term return expectations. If these projects don't have great long-term return expectations, then they might not be something that's applicable for these schemes to invest in. So also mentioned here was that the PLSA has urged the government to develop a clear pipeline of what these investable projects are. Because if you think about it, there's kind of two different areas. So there's one area which is public investment initiatives that the government are trying to fund. And then on the other side, you have these scheme-specific investment strategies. So these might not marry up with each other. We need to make sure that the projects that are being funded will actually align with what the schemes need, or else we might not see that push from the schemes to invest in these different projects. So I definitely think it's good. It's a pro-growth investment environment for the UK, which is obviously a good place to be in. But yeah, they definitely need to just consider how that alignment's going to take place. And then also for trustees, there'll be an issue with if they've invested too much into these projects, it might limit the diversification of their assets. And then also there's some risk issues. So there might be a concentration of risk if you're investing in a lot of similar assets in a similar geography. So just something to be aware about with these different investments that the government's starting.
Yeah, no, it's interesting, isn't it? I mean, this is all part of that, as you say, that drive to create opportunities that is part of that Mansion House Accord. This is sort of the government doing their side of the deal, or at least starting to. And yeah, I think the point about having a pipeline is well made, isn't it? Because if you've got this we talked about mandation a second ago, if you've got these sort of pledges and potentials for mandation hanging over you, people might rush to go into something to fulfill their requirement, but without actually thinking, is this right? Is this the right allocation? Because you don't want to be committed and then having to disinvest for something that you've intended to be in for 10, 20, 30 years. And there's also concerns, talking to yourself and colleagues, around this over the last few weeks, you start worrying about the creation of the opportunities over a short time scale and what the pricing of that will be like when you've got a bunch of assets over here the government want to be used. Then you create these opportunities. Does that distort the price? Does it create a fair market value? And I'm not an expert in private markets, but I know the valuation of those assets can be controversial and sometimes opaque and not always well understood. Definitely not by me. And so if those prices aren't well understood and are inflated in some way, that might be an issue for long-term returns. If you bought at a higher price than perhaps you would have done in a normal, functioning situation where you would just find opportunities, bit by bit, rather than having a lot of capital allocated to them in a sort of relatively short period of time. So there's definitely some issues, around these allocations to productive finance to make sure that there isn't a loser on one side. The government gets the money they need. That's great. As you say, and as you mentioned, that is good. But then there isn't a compromise on the return because of the environment where the allocation is made. So.
Thanks everyone for listening, and just an announcement that there won't be a Pensions in 10 next week, but we'll be back in 2 weeks. Thanks.